name is Scott Andrews, and welcome to today's presentation. Matt and I will be tag teaming it. I'm going to jump right into it. We'll try to keep it to 45 minutes if we can. I think an hour is a bit long, so we've been trying to keep these briefer. I'll get us started, turn it over to Matt, and then I'll wrap it up at the end. You should be seeing our slides, and you should be hearing me loud and clear. If not, go ahead and speak up, and Matt will try to help you as I get us going here. Uh, the required disclaimer, we will be showing quite a bit of back-tested information using our Discover platform. It is all hypothetical. These are just to make sure you're aware, and hypothetical back testing is an imperfect science, but it's the best tool we've got. It can give you insight into the markets, into what may happen, probably, in my belief, better than any other approach, including charts, because charts, you're subject to so many more human emotions. In fact, just a quick side note, for those of you who don't remember or realize this, I got my start in the bull market after the dot-com crash, so back in 2003 or so. Took a few years and was exploring intraday strategies. I wanted to trade and take advantage of volatility while avoiding the overnight volatility. And we launched the company. We had took a while, but we got some success. David was helping me, our other co-founder. He's my right-hand man doing the quantitative analysis. And sure enough, we launched. We're doing great. I think I launched a blog in September of 2007. And I think we put a PayPal button on the site in January of 2008. Started selling access to my signals. We had a ton of interest, and that, of course, was pretty much the top and beginning of the financial crisis. So I had nothing but bull market experience in my own trading in this prior 3, 4, 5 years, and had to rely solely on back-tested information from our own systems, and it was scary. Fortunately, they stood up fairly well. We had about 10 years of data. And that's actually been the model we've used historically, roughly a 10-year rolling window that covers multiple timeframes of market conditions can be sufficient to give you some excellent insight into what may happen. So, but it's still imperfect. Use this information at your own risk. I've already gone 2 minutes longer than I anticipated just on the disclaimer. I'll do better. All right. Today's agenda. So basically, we're going to show you some examples of the difference, in some cases stark differences between bull and bear markets, high vol and low vol markets. Then Matt's going to show you some specific scenarios actually to highlight those and actually arm you with some different setups that will help you stay on the right side of the market moving forward, assuming we stay in a bear and high vol market. I'll quickly highlight some enhancements, any that Matt misses as he goes through the platform. He will be using Discover to do all this research, which is our code-free backtesting platform. And at the end, I'll also introduce you a little bit more broadly to the company overall and the types of solutions we have. One size does not fit all, and we address pretty much the entire continuum in terms of our support, quantitative support for traders, and we've been doing it, as I mentioned, for more than 10 years. This is our 12th year. The company was originally called Master the Gap. We changed the name to InvestaQuant in 2015, I believe. So anyhow, Matt, it's all yours.
All right. Thank you, Scott. Let me head over to the next slide here. You guys should be able to hear me. Looks like it is working properly. So what we're going to be doing today is we're just going to look at a handful of different trading setups, seasonality type stuff, as well as technical stuff. So I've got 5 different examples here that we're going to look at. 4 of them will be based off of trading at the open of regular trading hours, 9:30 a.m. Eastern Time, exiting at 4:15 p.m. Eastern Time, so catching the intraday bias that's happening during that time period. And what I'm wanting to do is specifically zone in on how these patterns perform in different regimes. And regime, what we're meaning by that is the market in a really bullish state whatever's happening tends to be heading higher versus a very bullish environment or a very bearish environment, which we've obviously just gone into, and it's just a completely different market that's trading at this point. So we'll look at these different setups here. One's just gapping down. What's that look like in a bullish environment versus a bearish environment? Seasonality stuff like last trading days of the month, Mondays, a technical pattern, as well as another type of setup. I'll explain this high breakout as well. Um, and we'll look at the differences. And if I'm not taking too much time, I'll look at some volatility environments as well, doing the same idea. And then we will hand it back to Scott to close out. So let me go to the next slide. And did I tell you the testing criteria already? I feel like I skipped that. Let's go over the testing criteria first. I showed you the patterns already. So the testing criteria, everything's going to be based on the E-mini S&P 500 futures. If you trade spiders or something else, it will likely be highly correlated to that if you're looking at the S&P market. Entry assumes a market order at the entry time or location that we're looking at. The entry time for the open is 9:30 a.m. Eastern time. The exit for all of these is 4:15 p.m. Eastern time, so that is the close of regular trading hours. There is no slippage and commission included in any of these tests that we'll be running. Do that on purpose so that it does not distort the bias that I am showing. These are not strategies that you're just going to take and start trading right away, so it shouldn't really matter, but that can distort a bias that's being shown if you include them. So no slippage and commissions, and again, results here are all hypothetical. They are based on data from January 1st, 2003 through March 24th, 2020. All right, so with that said, I will hop into Discover. Let me turn on my screen here, and we will dig in to these 5 different setups, and then looking at them in the different environments as well. All right, my screen is about to show up. I think. Here it comes. All right, this is our Discover platform. Yeah, feel free to ask questions if you got them as we go along. Scott, I probably won't see them, so interrupt me if you need to when they come. This is our platform. What we're going to be doing is digging into the Discover section of the platform. Discover is where you do all of the testing of ideas. The way it's laid out up here, you can see up top, everything that I'm testing is going to be shown up in this top section, which is the header section. Whenever I add a price pattern, you'll see it appear up here. You'll also be able to see like the trade type, what exactly we're testing. It'll say long or high breakout, setup, intraday open. That's the 9:30 a.m. Eastern time. Our look back period, as well as anything else that I add will show up here. The first thing that we're going to look at is we're going to be starting in the ES, the intraday open. I'm going to set this up as a long trade. And what we're going to look at is gapping down in a bullish environment versus gapping down in a bearish environment, and note the differences. So I'm going to come into opening filters here, select gap down. And the way I'm going to be defining this bullish versus bearish environment or regime is going to be based off of using a couple moving averages here at first, and then assuming we have time, we can look at using the VIX, which some of you may use, looking at higher VIX periods versus lower VIX periods. But for this one, we're going to start with looking at when the market is trading above a 10-day moving average. So if I click here above the 10 and above the 200-day moving average, that's going to be a more bullish environment. So if anybody doesn't know what a moving average is, feel free to ask. We can go over that quickly as well. And next, I am going to hit View Results. And these are the results of going long when the market gaps down. So by gap down, that just means it's opening below the prior day's closing price. And we're defining the closing price as 4:15 p.m. Eastern time. So at 9:30 a.m., if it's trading below the price it was at 4:15 p.m. Eastern time the prior day, that's considered a gap down. This is going long in the bullish environment here. So about a 58% win rate, average trade around 36 bucks, profit factor 1.22, equity curve heading in the right direction, just kind of marching higher. So this is just gapping down in a bullish environment. All right, next, what I'm going to do is I'm going to open this up in a second browser. I think this will be helpful to show you it this way. And I'm going to look at this same setup in a bearish environment. So you just right click on Discover and open up a new one. I'm going to go back here, Discover, and set up the exact same test except put it in a bearish environment. So what we were looking at, again, ES, intraday open 9:30 a.m. Eastern time was the entry time, set up as a long. We are looking specifically at when gapping down. So I'm going to come to opening filter, select gap down, and I'm going to put it in a bearish environment. So I'm defining the bearish environment now as the prior day closing below the 10-day moving average and below the 200-day moving average. So it's below its short-term trend, which is defined as the short-term moving average, and its long-term trend, which is being defined as its slower moving average, the 200-day moving average. So if I click View Results, we will see the results of going long on a down gap in this more bearish environment. So here, win rates down to 52%, average trade losing 22 bucks a trade on average, profit factor 0.94. For those that don't know what a profit factor is, it's just a measure of profitability. Let me just hover over profit factor so you can read the tooltip there. But in general, above 1 is profitable, below 1 is not profitable. So it's just a metric to tell you how profitable the system is. So looking at this one, this equity curve, not attractive at all. Kind of looks like an EKG machine there, just up and down, absolutely no bias. But when you compare that to the bullish environment here on the other tab, look how steady that is. Win rates much stronger. Profit factor, profitable above 1, average trade 36 bucks. So big difference when you look at these two in comparison with each other. The exact same setup, just simply in a bullish environment versus a bearish environment. All right, so that is gapping down in a bullish environment versus a bearish environment. The next one I want to do is come into opening filters. We will remove the gap direction, and we will go into our calendar section and select the last trading day of the month. So we will be looking at every last trading day of the month in a bullish environment. And I'll set that up over here on my other screen before I show it. Same thing in a bearish environment. So let me get that set up here by removing the down gap and then selecting last trading day of the month. All right, they are both set up exactly the same now, with the difference being the environment that they're in. So the first one we're going to look at is the bullish environment, last trading day of the month, going long. This one, pretty poor, pretty consistent loser if going long. This is one you may want to think about shorting in a bullish environment. So, I mean, there are certainly good opportunities in bullish environments to be thinking about the short side or thinking about the long side in bearish environments. This one, in a bullish environment, above the 10, above the 200-day moving average, last trading day of the month, consistently weak. 42% win rate here, average trade down to 93 bucks as a average loss, and profit factor 0.57. Equity curve very smooth here to the downside for no stop, no target. A pretty consistent bias there. And if we go to a bearish environment, and again, the bearish environment versus bullish environment that I'm using is a 10 and 200-day moving average. So the bearish environment is below the 10-day moving average and below the 200-day moving average. The bullish environment is just the opposite. It is above the 10-day moving average and above the 10-day moving average as well. So this is the bearish environment going long on last trading day of the month. So this one does not happen as much. Obviously, this is something that can only happen once a month, and it doesn't happen in that environment all that often. But when it has, it certainly has not been bearish like we saw in the other one. So this one, 60% win rate, big average trade, big profit factor, and equity curve moving higher as well, but quite a difference here in the bearish environment. So these are both set up as longs versus the bullish environment, which is over here with the downward sloping equity curve. So bullish environment, it has been a short bias off the open, whereas in a bearish environment, it's been a long bias off the open. So completely different. All right, let's look at another one. Let's dig into Mondays and down gaps on Mondays specifically. So I'll set that up there, come back to it. We'll set it up on the bullish one as well. So opening filter, down gap. Then if we go to calendar, this is where I can find all of my seasonality stuff. I can select Monday. So the first one we will be looking at again is a down gap going long in a bullish environment on Mondays. Click View Results. These are the results of going long, a down gap on Mondays when you are above the 10 and above the 200-day moving average. Win rate coming in around 54%, average trade about 33 bucks, profit factor 1.22. So this isn't nothing to be crazy excited about, but general bias leaning to the long side here. Mondays in a bullish environment when gapping down. We can contrast that with what it looks like in a bearish environment. So if I come back over here to the bearish side, I've got it set up here for gapping down on Mondays below the 10, below the 200 results. Here we go. So in a bearish environment, gapping down on Mondays, quite poor. 38% win rate. Average trade, very weak, minus 418 bucks. Very weak profit factor. So this is set up as a long, but when you see an equity curve like that, that tells you need to be thinking about trading in the other direction. So this would show a short bias on Mondays when gapping down in a weak environment compared to bullish environment. Gapping down has typically led to more bullish price action throughout the day. So closing higher than the open is what that's telling you. So again, this is bullish, same setup, bearish with the same setup. Drastic difference. All right, let's look at another one that is more technically based. So let me clear out. We've looked at a couple seasonality things here. Next, I'm going to share a price pattern with you, and it's going to be based on a gap up after a weekday. So the way I'm defining that gap up, the weekday, I'm going to come in here to price patterns, and we're just going to say the day closed in the bottom 25% of its range. So if you break up the day's range into quartiles, it closes in the bottom quartile of its range. If I come here, price patterns, location, last open and close in bottom 25% of daily range, hit equals next to it. You'll be able to see it's up here in the header section. Now let me set that up in the bearish environment as well. So to do that, I need to clear out Mondays, change the opening filter to a gap up, and then add the price pattern that it is closing in the bottom quartile of the daily range. There we go. Let's look at the bull market environment first. So let me hit view results here. We are above the 10, above the 200 in this environment. And going long and up gap after a day that closes in the bottom quarter of its range in a bullish environment has been very weak. Look at the equity curve there. That one is very smooth to the downside. In fact, that looks a lot like that last trading day of the month equity curve that we showed with the short bias for a bullish environment. This is very similar here. Win rate coming in 47%. Average trade quite weak, minus $75. Profit factor 0.65. This one not so impressive. Equity curve very smooth for such a simple bias there. And if we look at this exact same setup in the bearish environment, only thing that's going to change is below the 10 and below the 200. Completely opposite. So this one, 58% win rate, 58% of these closing above the open on that day. So pretty strong win rate, big average trade, big profit factor. Average win, not only is it a drastically different win rate, the average win is sizably larger than the average loss. So this equity curve looks a bit flat at periods here, and that's just because there's no trades taking place during those times. That was a pretty bullish environment. That one's certainly sloping in the direction that you want, and if you focus here, 2008, potentially a similar environment to what we're in right now. This one did quite well. Very strong run up here in the 2008 period. Again, this is going long when the prior day closes in the bottom quartile of its range in a bearish environment compared to a bullish environment here going long and just completely getting ran over. So very, very different results with the exact same setup applied to different market regimes. All right, let's do the next one here, which is going to be a different setup. So we've looked at some stuff off the open. Now I want to show you 60-minute high breakouts in these different environments. So I'm going to come in here to setup 60-minute high breakouts and exit. Throw that back to end of day stop, end of day target. And to remove the price pattern that we just looked at. So just hit the equals there. And we will look at gapping down. I may do both actually. And set it up over on the bullish one as well. Exit end of day. That is 4:15 p.m. Eastern time. We'll be looking at gapping down price pattern Needs to be cleared out of this one. And you know what, before I do this, let me just show you real quick what I mean by this. 60-minute high breakout, what that is you look at the first 60 minutes of the regular trading hours. So that's defined as 9:30 a.m. to 10:30 a.m. Eastern Time. And then a high breakout triggers as soon as you trade one tick above the high of the first 60 minutes. So the 60-minute opening range is marked here in the blue. We've got the 60-minute opening range high. My cursor is, and then down here at the bottom, the 60-minute opening range low was right here near the low. This is yesterday's price action. You can see a little bit before noon in the S&P, it broke that 60-minute high, and that would be an entry on a high breakout if that was a setup you were taking. So just getting long one tick above the high of the first 60 minutes traded, or the range traded in the first 60 minutes, is the high breakout setup. All right, so let me come back, and we will be looking at gapping down and taking a 60-minute high breakout, which is a long trade in a bullish environment here. Let me hit view results. So these are the results of going long, 60-minute high breakout in the more bullish environment on a down gap. This one, not all that impressive. Overall, kind of a messy equity curve. Win rate slightly favored, 54%. Average trade not amounting to much. Profit factor hanging around 1.0, so just mildly profitable. Certainly nothing to be too excited about, but has worked a little bit here in the recent environment. Now let's compare that with a more bearish environment. Exact same setup, 60-minute high breakout, gapping down. And this one has been awful. So this is a long trade in a bearish environment that is not working well. Win rate on these coming in around 43%. And not only are they losing more often than they win, they're losing bigger than they win. So average trade, minus $209. Profit factor, 0.52. Equity curve, quite poor. This did very poorly in 2008. You can see just kind of straight down here, maybe one or two winners. And this little peak and then straight down again, and has been doing very poorly here in recent environments as well. So differences, this is the bear market, this is the bull market. Bear, bull, 60-minute high breakouts when gapping down. All right, let me do one more here. And I'm just going to stick on this same thing, and we're going to look at the gap direction with the exact same trade. So it'll be a 60-minute high breakout when gapping up in a bearish environment versus a 60-minute high breakout when gapping down in a bearish environment. So the first one we'll look at, up gaps in the bullish environment above the 10, above the 200. This is a 60-minute high breakout. View results. Not much of an edge here. Like the other high breakout that we looked at in the bullish environment, neither one of them showing a strong edge. Win rates just barely above 50. Average trades hanging around 0 for both of them, not really getting far away from that. Profit factors hanging around 1. No discernible edge here, just kind of a mess on the equity curve. Certainly nothing to be excited about. So let's compare that with the exact same setup in the bearish environment. Hit view results. This is a 60-minute high breakout when gapping up in the bearish environment. So this one noticeably better. Equity curve certainly pointing in the right direction. See here again, 2008, very strong. This one just kind of went parabolic during the last crash. Win rates around 57%, average trade pretty big, a buck 140, profit factor of 1.6, average trade bigger than the average loss. Again, this is a 60-minute high breakout when gapping up in a bearish environment. So this is a long trade in a bearish environment compared to the bullish environment here, which kind of does nothing. So this long trade in a bullish environment, not so impressive. You put it in the bearish environment, all of a sudden it starts coming alive. Again, this is bearish environment. This is bullish environment. Exact same trade setup. All right, it is 5 o'clock. I tell you what, I am going to stop here. I was going to do some stuff with the VIX as well. You can do some volatility studies using where the VIX closed at by using our volatility section. So like a VIX one-day moving average, you can do some tests on higher VIXs versus lower VIX levels and seeing how they perform in the different volatility environments. However, you know, in the slides I've already put some of the stats together, so you will be able to see the results. I'm just going to not take up all of your time going through all the tests with them, so you'll still get all the goods in the next slides that I'll show you here quickly. So let me go back to...
Hey, Matt.
Yeah.
While you're there, just point out a couple of the enhancements, the areas of enhancements, because some people recognize some names that were in here a few months ago that maybe haven't seen, like the profile or
So
just real quickly before you get to...
Yeah, some of the more recent stuff that we've added here, we now have equity ETFs. So these are your four corresponding ETFs to the indices. So you got your spiders, the Qs, the diamonds, the Russell IWM here, as well as the select sectors ETFs. So like XLF is one of the really big ones there, XLE, XLK, which is technology sector. We've got all of those available here as well. So new asset groups are available. And then profile patterns was a real big one as well. Profile patterns are all based on market profiles. So this is, as far as I know, the only available solution to be able to test market profile patterns, which is pretty cool. And we've got a lot of the more common stuff that you profilers will be aware of. So your prior day types, you can test ideas based on where was the point of control relative to other technical levels, value areas, close, initial balance, where was it in its range, all kinds of good stuff. Hawk width. So this is how you can test ways of how balanced was the day. On a very balanced day, you can obviously get really wide points of control. So you can test ideas based on that here with the POC width section. We've got ways to test how value is moving. So value area is moving higher, lower, going lower, and then starting to go higher. All kinds of good stuff there, as well as excess at the prior day high and close. That's probably Greek to those of you who are not profile traders, but this is an important concept in market profile, and we have the ability to test that here in the prior high and low section. So lots of good stuff showing up there. Also have, let me show you real quick, the new...
Hey, Matt, in fact, while you're there, so I don't have to come back to it, just maybe real quickly, just at a high level, click on each section above, and then I will not come back to the site. We can wrap up when we get back to the slides. After you do your strategies and alerts, just hit IQ Wedges and analyze and even SSE, just the high level. Just like two minutes total.
Sure.
You can.
So strategies, this is where you can save all the strategies that you create and enable them for alerts. You can search them. You can see I got a bunch of them in here, so it's kind of hard to keep track of, but you can search them if you're just looking for, a 15-minute high breakout trade, narrow them down quickly. If you click on any of these buttons over here on the right, you'll be able to load the equity curves and stuff back into Discover so you can test or see how they've been performing. There's a button here to enable the alerts for any time that they are active. They'll show up in your alerts section. Next to that, we've got the bias library, which is something we just put out, which has a bunch of research for you guys to get started with. So you can come in here, take a look at some of these. If you click this button on the far right, it'll load it into Discover, and it'll give you a bias that you can either turn into your own alert by coming down to the bottom and saving it. You can rename it whatever, or it can just be something that you want to use as a starting point for a strategy. There's a lot of interesting biases in here that you can work off of, so you don't have to start without knowing anything. They're good starting points that you can start with. The alerts button over here, we now have my alerts, which are the ones that you create on your own, bias alerts, which are the biases that I just showed you from the bias libraries. We've put them into their own section here, so you'll know when they're in play for the current day. So today we had one here, volatility expansion. This is a short setup. You can see here trade type short at the open after volatility expansion. We've got a bunch of those enabled, and then we've got a new alert as well in the IQ alerts, which was not active today. Scott can tell you a little bit more about that. And the other sections here real quick, SSE. Up top, SSE is a statistical database where you can just kind of look for the good stuff. So you can put in criteria into any of these boxes up top. Like if you only want to see something with a 55% win rate and at least 200 trades, you can just start typing in criteria, and as you do that, it starts narrowing down all of our different factors within our library here. It starts narrowing them down so that you can find some of the better ones, focus on some of the strongest patterns. So once you find whatever it is you're looking at, you just click on the button here on the far right, and it will load it into Discover. And you can use this as well as a building block for a strategy if you choose to. That is very helpful to quickly find some of the best stuff within our platform. And then lastly, Analyze here is it's like a scanner for what is in play for the current day. So we've got a ton of different things that you can test within our Discover libraries. And we put them here on Discover on a daily basis. This updates daily. And you can see which of those factors are in play for the current day. So calendar will be real obvious if I click on that. So today is Wednesday. It is the 25th. It is the last quartile of the month. It's March, and it's the first quarter of the year. So all of these things are true for the day. And we tell you the stats of each of these factors based on all available, only the up gaps, and only the down gaps. So if you look at this top one, Wednesday, every Wednesday in our database, if you were to take the trade long, and this is based on entering at the open because the setup up top here is set to open, it would have a win rate historically of 55.1 and 1.09 on the profit factor. If you looked at just the Wednesdays that gap down, you can see those have been more bullish. It's got a 58% win rate and 1.17 profit factor. And we do this for all of our different libraries. So we've got market events, calendar, price patterns. That's where that bottom and the close in the bottom quartile of the range would be found. Our market profile stuff, the indicators, so this is where you would find like below the 10, below the 200. Everything that is true for today is going to fall in one of these categories. And you can use this as a way to quickly size up what is happening. If you click on any of these, it'll load it into Discover. So if I look at down gaps on Wednesdays, if I just click on this 1.17 or any of these hyperlinked numbers, it will load it into Discover so I can see the equity curve and start working on it from there. So that is what Analyze
And Matt,
is.
last thing, just show a picture of IQ Wedges. We're not going to go in and explain it, just the 10-second version, because I'm going to reference it in just a moment.
Yeah, so IQ edges give you, I've got this set to heat maps here, and what it does is it splits the opening areas for the current day into different sections and tells you probabilities historically of what has happened when you're opening in those different opening locations. So for today, the ES opened in this section right here, and you can see just looking at this, it's a little bit red. That means going long, this is set up as a gap follow. So for opening in this section, that would be a long trade. It has not worked very well historically. These can be super helpful when they're all kind of screaming a certain color. Like this one up here is all green. So had you opened above 25.04 this morning, there's a lot of consensus here saying the long side. That happened yesterday and worked out quite well. But these are based on some of our systems. We have 5 systems that go into these and create historical odds that can tell you which direction to potentially lean on for the current trading day. So that is a real high level overview, and you'll probably want to know a whole lot more, but we won't dig into that right now.
Thanks, Matt. You can get back to the slides, show the quick summary of the statistics that we showed, and then I'll talk about some of our new flexible options for folks.
Yes, so these are the stats. These will be available in the recording, so you'll be able to just pause the recording and look at this. But these are the stats of what I went over, and you can kind of notice the giant differences in some of these setups. So this is the bull market versus the bear market. And specifically, some of these, the bottom 3, there are some noticeably different characteristics there that really stand out. But those are win rate and average trade. That's what WR and AT stands for. If you look down there at the bottom of the slide, there is a definition for how those are calculated. AT average trade calculated by dividing the hypothetical net profits by the trade count. And then win rate is probably a little bit more obvious to most. But this is the bull market environment, so above the 10 and above the 200 versus below the 10 and below the 200. And next slide, I was going to show VIX levels with the same setup. So when the VIX is below 13 versus the VIX being above 25, and those are some numbers to use for a low volatility market versus a high volatility market. And you'll notice the numbers, they tend to have similar characteristics. So, a more bearish regime is typically a more or a higher volatility regime, and a lower volatility regime is similar to a strong bull market. So they are different, but they do have some overlap as well. So these will be included. We won't spend too much more time on that since it's already getting near the 45-minute mark. All right, let me pass it back to Scott. He can take over from here and finish up.
Great, thank you, Matt. Yeah, pretty. Some of that I knew, some of that I did not know myself. So pretty interesting. Stark difference as regimes change, so do the probabilities. Certainly, one factor doesn't necessarily is enough to lean on, but when you start seeing multiple factors line up, and that's why we make it so easy to save these different edges and risk factors and be alerted on them. When you see a bunch of them lining in a certain direction, it starts painting a pretty clear picture. You can also use those IQ edges that we mentioned that he showed briefly. Those are ensembles of our systems that are very strong technically as well. But let's see, you covered the ETFs, market profile, bias libraries, starting points. IQ alerts, we didn't have any trigger today, but we did have one yesterday. And I did want to point that out. That is something brand new. It's based upon very old is good in this case, tried and true systems, our core ensemble systems, or systems that we ensemble together. We've created a directional alert. It's a little bit black box, but it's embedded in the platform, and we'll keep. Our goal is to try to keep you on the right side of the market and give you helpful information. So not only do the bias alerts show up in your browser as a client, but also these IQ alerts when there's a strong indication one way or the other. And we have one yesterday to the long side that was very clear, and they've been uh, consistently very strong since we launched them in 2013. I'll probably do a webinar on that. I actually did one yesterday for an options group that was really well received. I'll probably do a webinar on that concept soon, but they're embedded within the platform. Um, we're always making changes to the platform. Lots of new things coming. We're really going to be building out alerts to make it very easy for you to be notified when something's in play. So watch for that. And let's see, let me go to the next slide. At a high level, if this is the first exposure you've had to us, we may have blown you away there. There's a lot underneath the hood with the platform, and that's why we've broken it down into some different pieces that I'll talk about in just a moment. But if you think real big picture, and maybe we should have started with this, but I just didn't want to be too salesy. We're empowering intraday traders for the entire continuum of the process, everything from selection. So if you just want help being a little bit more selective, let's say you've got an edge and you want to improve your selectivity, trade a little less, try to capture the better trades. It's a tremendous way to improve the profitability of your strategy because it often doesn't take a lot, at least in our analysis, and work with traders for more than a decade. So we've got this alert function on the sort of the front end that we mentioned, as well as you can use Analyze to actually identify factors that may be in play that you hadn't thought of in the past. So that's what some clients do. For edge discovery, we were showing you that just now with the backtesting capabilities and the ability to save those as edges or strategies and be notified and alerted when they're in play. You can also test different entries and exits, whether it be different time frames. Every 15 minutes you can increment. We didn't show that. We do have range trades as well, high breakouts and low breakouts, high fades and low fades, different time frames, 15, 30, 60 minute. Again, we've just got too much to show in a single webinar. That's why we tend to cover different topics each one. Management is arguably one of the most exciting things we do for a lot of our clients, especially the swing traders, full-time professional traders. There's so many unique scenarios that can happen in a given day. It's impossible to keep up with what's the right thing to do. And it's also impossible to test it with traditional software solutions in real time. It takes too long, right? That's one of the reasons we built the platform the way we did it. So you can actually go in and contextually analyze uh, nearly an infinite number of scenarios that could happen in a given day based upon the gap filling or not filling, trading above or below a 2-day high or low, a 5-day high or low, a 10-day high or low, um, and so on. And it goes on and on and on, and it can give you some tremendous insight of what may happen for the rest of the session. So that's very exciting, but that's a whole different webinar we'll do on another day. And then as Matt showed you today also, just core market knowledge, understanding the directional edges and biases that may exist for different types of regimes. Critically important, especially in light of what's happened lately. So, we do have a broad um, focus of solutions. They organize, just one or two more slides here and then I'll let you go. Um, Signals and alerts, we haven't really talked much about that in a while, but as I mentioned, that's going to be the front end of the platform. So if you want to get started in the least expensive manner and you just want a little directional help or selectivity help with your own edges, need another vote to determine if you should be full size or partial size or even which direction you're leaning towards. Alerts is a standalone option that's being developed. Um, um, and available actually starting this coming month. So we'll be building that out further. If that's all you're interested in, let us know. The IQ Wedges has been our bread and butter for years that we just showed you. We launched those in 2013. And that's we've got CTAs and professional traders that license us solely to get assistance with that directional analytic confirmation. Very powerful, very robust, and another tool for those of you who are looking for assistance with your own edges. If you want to create strategies from scratch or do regime research, you can use a Discover platform like we just showed you. And then we even have the database component. If you're an algorithmic trader, systematic trader and you're just looking for the best factor combinations, it's a tremendous tool. I will warn you, it's also our most expensive tool because you're searching. We've got over 1 million different factor combinations in the database right now, and that grows. I think it grew 20% last month alone. So that is available if interested. And we do have solutions for firms. We can offer configured white label solutions for prop shops, hedge funds, trading groups.
Hey, Scott, can you hear me? I think we just lost you. Yeah, we don't hear you right now. So why don't you leave and come out and I'll tell them how to learn more. Yeah, so to learn more, on our website, if you go to investaquant.com, there will be a Learn More drop-down button up here that you can click on. We've got a couple different sections here. We've got the Daily IQ, which is a way that you can just get some research from me on a weekly basis. I pump out a handful of sayings a week that will be similar to some of the stuff I showed you today, but relevant to whatever is happening in the trading day. And you can also request a demo in that second button there, or on the far right, you can click the request info button, give us some information, and we can send you some more info. Brian at Investaquant is available as well, so you can always contact Brian at investaquant.com, and he can talk to you about your best options, what's going to be the best fit for you depending on what you want to do. So lastly, it says here, sign up for, oh, go ahead, Scott. I was just finishing up the 3 different options, and you can talk about the...
Yeah, no problem. So just real quickly, I do want to be clear. We've done a couple things trying to basically be more price friendly, I guess, more flexible with clients. We recognize we've got traders of all types and all account sizes. And we also recognize these are pretty stressful times and a lot of unknowns out there. We believe strongly, and many of our clients do as well, that it's a great time to be a discretionary trader with such incredible movement. But if you're a systematic trader, which we do a lot of systematic trading, you might want to shut your systems off or de-throttle them and use, say, micros, for example. So, or if you're just newer to discretionary trading, you should not be trading this environment. You should be doing research. Research is absolutely a requirement to be successful on a long-term basis. There are plenty of strategies that work for a little bit of time, but nothing works all the time. So you need a robust quantitative support. That's what we're here to do. And because of the environment we're in right now, we're going to offer a 1-month trial subscription with monthly recurring subscription options for you. So if you are interested in that, it's not possible we'll continue doing that, but we're certainly going to offer it at least the rest of this month. Maybe next month as well. We'll just see how it goes. But if you are interested in digging in to anything we've shown you there, all you got to do is reach out to Brian. Brian, I call him our client satisfaction person. His job is to make sure you're in the right solution configured for your needs and that you're satisfied. So we know part of satisfaction is working with your budget. So pricing is variable depending upon how many features you want and how many asset groups you're trading. But reach out to Brian, and again, suggest you get started this month. If interested, it's a great time. And with that, I will open up to any questions that we haven't covered. We are a little bit long. We're about 10 minutes longer than I wanted, but we covered a lot of ground too. So nice job. To you, Matt.
Thank you. Let's see, I'm going to scroll up here, see if there's anything that I might have missed.
Yeah, Matt Blankenship there was asking about automation. Matt, I wasn't exactly sure of the nature of your question, but if you're looking for automatic or systematic mining of data, you can use our database, which we call the SSE database. In terms of programming the edges, it was really designed to enable and create or prototype rules-based strategies and then alert you on them for manual or discretionary execution, more so than automation. But if you wanted to elaborate further, if that didn't answer your question, let me know. or we can take it offline as well.
MK, let me show you real quick. You were asking about slippage and commission. Let me just show you where you can do that. Turn my screen. It's about to come. Yeah, here we go. So in this Discover section, the symbol and settings, you can put in whatever slippage and commission that you want for your test, and have it deducted from anything that you're testing. I did not include those in any of the tests that I ran because what I was generally trying to show are some biases, and when you include slippage and commissions on things, you can often get rid of the bias just because of slippage and commissions. But when it comes time to creating a rules-based strategy, you definitely want to be looking at adding slippage and commission and making sure that it's still able to hold up with the slippage and commission added to it. But when I do my typical just research, is there a bias with something, typically leave that at 0, and then drill in when I'm ready to really refine the setup to something that's more rules-based.
Mohammed, I just typed a quick response there, but if anyone else is interested, we've had legacy end-of-day subscribers in the past that looked at some of our special studies with some simple market condition filters. All of that, as I think we just showed you, can be created in a much more robust fashion if you want with the platform. But if you're just looking for the directional information, the probabilistic information as an input into your own system or trading, highly recommend you check out the platform and our new IQ alerts. They are based on much more robust analysis in our systems, and they spit out edges it varies, of course, but I think we've been averaging every 3 or 4 days is a really strong number. But you can create your own and get alerted and set up your own complete custom and much more expansive approach if you want. And like I said, we do have, we are doing away with anything that's flat out free, but we are also cost conscious for folks. So we've got some very flexible pricing. Pricing actually starts on the alerts at $99 a month, just to give you an idea. So pretty reasonable considering kind of information you're getting, we think. So, but talk to Brian, let him know your specific needs, and we can take it from there. Any other questions? All right. That's enough fun for one day. I see someone else typing. I'll hang in there just for a minute more. Oh, you're welcome. Okay, appreciate the questions and interest. Oh, no problem, Matt. Good to see everyone here. Hope everyone's doing well. This is all fun and interesting and exciting, trading the markets, but and the volatility is just awesome. However, it's all for the wrong reason, unfortunately. So, thoughts and prayers to everyone that's being impacted, which I guess is most everyone in the world now, but especially if you're directly impacted. We mean that sincerely. I wish you all the very best. And if we can ever help you in any way, you let us know. Oh, Dale, appreciate you saying that. Yeah, a lot of folks, we're getting a lot of responses like that. I don't want to overstate it. Not everyone, I'm sure, is doing well, but a lot of people saying they have the best trading results they've ever had. So I'm glad you're having success with the platform. And good to see some of our clients in here as well. So, and former clients too. So come on back. We'd love to have you. If anyone wants to reach out to me by chance also directly, Brian's your best choice. He'll be your best answer, but you can reach out to me. Just don't be surprised if I'm a little slower. We're quite busy, as you can imagine, and you'll probably get a little quick response from others, but I'm always happy to help as well. So with that, let's conclude it. Oh, you too, Rob. That's right. This too shall pass. So take care, everyone, and I hope to see you sometime soon.